Hello everyone. In this video, we'll go over the main concepts of Chapter 5. In Chapter 5, the first thing we learn is about net sales. To calculate net sales, we'll have sales and taking away sales discount, sales returns, and sales allowances. Here we have trade discount. Notice that trade discount is taken right when the sales invoice is generated. In this example, Giles agency offers a 10% trade discount if the customer purchased $1,000 or more. So Audrey's purchased $2,500 in services, and Michael's Motors purchased $600 in services. So recording these two transactions, we can see that the $2,500 service is recorded as $2,250 because the 10% trade discount was taken right when we record the service revenue. And for Michael's, because the services was less than $1,000, then service revenue is recorded at the full amount. Now, in the case of sales discount, we'll look at a different scenario. We have medical wait services provide services on account to Grace Hospital for $10,000. And the terms are 3, 10, and net 30, meaning that if the sales invoice was paid within 10 days, Grace Hospital is entitled to 3% sales discount. Grace pays for those services on March 20th. Notice from March 12th to March 20th, that's within 10 days. So let's look at how this is recorded. As you can see on March 12th, when the invoice was generated and service revenue is recorded, it's recorded as $10,000, which is the full amount, because at the time, medical waste does not know whether Grace Hospital is going to take advantage of the 3% sales discount. Only when the customer pays, then that's when you will know whether the sales discount was taken. That is the main reason why sales revenue is recorded at the full amount, as opposed to trade discount. When the sales revenue is recorded, you already know that the discount is taken. So on March 20th, Grace Hospital paid within the 10 days. So Grace Hospital took the 3% discount and paid $9,700. Cash is recorded $9,700, and then accounts receivable has to be write off at the full amount, $10,000, and the difference is recorded in a sales discount account. Now, the sales discount account, like sales returns and allowances, are considered contra account to sales. On the income statement, it's going to read total sales less sales discount, sales returns, and sales allowances, and that's how you reached net sales. The next main concept is how to record bad debt expense and to compute for net realizable value of accounts receivable. Now, you all know every company has accounts receivable, but not 100% of the accounts receivable are collectible. Let's look at this scenario. We have the first year of operation, Pave Construction provides services on account for $140,000. So by the end of the year, cash collections on these accounts total $100,000. So if they provided services of $140 and collect $100, then that means they have $40,000 in accounts receivable. So the company estimates that 30% of the uncollected accounts will be bad debt. Requirement 1 is record the adjusting entry for uncollectible accounts. Since this is a new company, then the uncollectible accounts will start at 0, and 30% of the $40,000 accounts receivable balance is the uncollectible account. Here we have $40,000 is the accounts receivable balance at the end of the year, and 30% is uncollectible. Therefore, $12,000 is debited to bad debt expense, and $12,000 is also credited to allowance for uncollectible accounts. So the net realizable value is $28,000, which is the balance of accounts receivable subtracting out the allowance for uncollectible accounts. The $28,000 in essence is what the company expects to collect for the $40,000 accounts receivable. Let's look at this scenario here. At the beginning of 2012, Brad's Heating and Air has balance of $25,000 in accounts receivable. BHA is a privately owned company, So the company used direct write-off method to account for uncollectible accounts. So, however, at the end of 2012, BHA wishes to obtain a loan, which requires a preparation of proper financial statements, which means BHA now will need to use the allowance method to account for bad debt. So, during 2012, the company installed air conditioning system for 180 and collect 175 from customers on account. So at the end of 2012, estimate that uncollectible account total 20% of ending accounts receivable. And in 2013, customers' accounts totaling 7,000 are written off as uncollectible. So we need to record transaction using allowance method. So we first record the service revenue for 180 and then the cash collection for 175. Notice that the company started out with 25,000 in accounts receivable. We added 180 to it, so that's 205. And after the collection of 175, that leaves the company with a $30,000 accounts receivable balance. And the company estimates 20% of it is uncollectible. Therefore, bad debt expense is recorded at 6,000 and the allowance account is also recorded at 6,000. And in 2013, the company write off actual bad debt of 7,000. So when you write off actual bad debt, of course, you credit accounts receivable by lowering accounts receivable because that account no longer exists. And then you use the allowance account to write it off. So notice that you have $6,000 here. By debiting 7,000, that means the company estimated the uncollectible would be 6,000, but in reality, the actual write-off for the coming year was 7,000. That means it's went over by $1,000. So that will give the allowance account a debit balance of 1,000. In other words, the company underestimated the bad debt expense. This concludes the demonstration for Chapter 5.